All right. Good afternoon, everyone. My name is Joaquín Torres, and we'll start in just a couple of moments to talk about Proposition 19. All right. Well, good afternoon, everyone, and thank you for joining us today. My name is Joaquín Torres, and I'm your elected Assessor-Recorder here in the City and County of San Francisco. Today, we're going to be discussing Proposition 19 and its impact to intergenerational property transfers and what that means for you as you plan for the future. So I want to thank everyone who signed up for the North Beach Proposition 19 presentation. And again, our apologies that we had to reschedule that at the last minute. We are recording today's session so that those who are unable to attend today are able to listen to what we share today. Next slide, please. So to begin, what I'm going to do is share some background about our office, and then we're going to go into property tax basics to ground our discussion around Proposition 19, how it might impact you, and also some key dates that we want you to keep in mind. This presentation is on the longer side to ensure that we're making the best use of your time and sharing as much that makes sense for us that you need to know, including some common examples and frequently asked questions that we've come across. Today, I'm joined by my public affairs team at the Assessor-Recorder's office, along with Sheree, who manages our transaction unit. At the end of the presentation, we're going to be available to answer any more questions that you might have. So you can type your question in the chat, or you can raise your hand during using the reaction buttons in the webinar menu, and we'll unmute you so you can speak and ask that question during the Q&A segment at the end. Our slide deck is going to be emailed to you shortly after our presentation so that you can refer back to that as you need. So just know that you will have access to this presentation so that your notes can be used accordingly. So why don't we go ahead and get started. Next slide, please. So just as a quick refresher about the primary responsibilities of our office, we assess and we record. There are two components of the office, of course, the assessor side and the recorder side. On the assessment side, it's about assessing property values, all real property in San Francisco. That includes residential and commercial properties, a hot topic of discussion, of course, during these times. The granting of property tax exemptions to ensure that those exemptions allowed to you by law or made available to you, and you have a clear path for taking advantage of those exemptions, whether you're a nonprofit, a charitable organization, or you're a homeowner or a veteran. And other exemption opportunities, making sure that you are aware of those and can take advantage of them to save your hard-earned dollars or to support your organization. In addition, we collect transfer tax within the office. It's the only tax that we directly collect. Everything else is for the treasurer and tax collector. And then finally, the recording of thousands of public documents, everything from recording your marriage certificate to reconveyance after you've paid off your mortgage and you finally own your home, in addition to so many other documents. Next slide, please. So the role in assessing property, we ensure the fiscal foundation of local government. If we don't do our job correctly and thoroughly, then the property tax revenues that should be collected to fund all of the fundamental services in San Francisco, we are unable to find those, uncollect them, and therefore that could have a revenue impact for the city and county. These property tax related functions to locate and assess property are governed by California state laws, including the state constitution and the Revenue and Taxation Code. Local laws also govern when and how and to what degree we collect transfer tax. In addition, as I mentioned, we're also responsible for the recording of those documents and maintaining those public records and making them accessible to you. Just to give you a sense of the numbers involved with our office, we enroll property value over $340 billion that generates approximately $4 billion in property tax revenue. That is the revenue source that is the single largest, most secure source for our city's general fund, especially important in these times. representing a contribution of over $2.6 billion, or nearly 1/3 of that overall general fund budget. Now, we're very proud of the fact that we are contributing to the sustainability of San Francisco, and we want to make sure that we as a city can continue to make those most pressing investments to support our needs as a city so that we can thrive. Everything from public safety to economic recovery to public education to transportation to our parks, homelessness, mental health, general health, affordable housing, family support services, and so much more that we fund here in the city and county of San Francisco. Next slide, please. Just a quick moment to talk about our mission and vision, that we're fairly and accurately identifying all accessible taxable property in San Francisco, recording, securing, and providing access to all of our records that we have available to you. And really, again, as I mentioned, that focus on the financial stability of San Francisco, at the same time being a model of good government and anti-racism by advancing our values of fairness, care, equity, and excellence in service to the diverse communities and constituents that we serve. We do this in our day-to-day work, but also through the programming, like our presence here with you today. Next slide, please. We ground our work by focusing on 4 pillars. We focus on the people, because that's who gets our work done, the systems to make sure that we can actually serve you, and we have modernized systems that are best positioned to serve you in this moment in time, coordination between our offices and other city departments, services to ensure that we're serving, of course, you, the public in office, and also engagement, bringing ourselves out into community as we recruit for positions, as we bring you information about policy measures that have an impact on you and your lives. All of that is about making sure that we are present in community, and also just structures our work. We understand that what we do can be very complicated and maybe confusing for taxpayers. So when it comes to tax issues, we know that you have questions. We know there might be anxiety surrounding changes in very complicated law, which have impacts for you and your families. And that's why it's important for us to be present like we are today, to strengthen your understanding, demystify the process, and also just put a face to government so you know that you can feel comfortable coming in, asking us questions and getting answers and clarity about issues that you may be facing related to your property. Next slide, please. Just as a disclaimer here, it's important for us to remind everyone that this is about general information in relationship to Proposition 19. This should not be considered official legal interpretation or guidance, but rather a summary of what you should know to inform your actions as a property owner. Now, if you need specific advice on a very particular situation you have, assets, estate planning tools, and tactics that you may want to pursue, given your circumstances, we strongly encourage you to consult with an attorney. If you need a referral to to an organization that provides these types of resources at a lower cost, we are going to go over a few of those groups that you can reach out to later in this presentation. Next slide, please. So for us here at the assessor's office, we are looking at the fair value or fair market value of the home at a time of the change in ownership. And we set that value as your taxable value. Now, under Proposition 13, a state constitution amendment that was passed back in 1978, which many of you have heard of, your property's assessed value is not able to increase by more than 2% on an annual basis. Proposition 13 also limited the property tax rate to no more than 1% plus any voter-approved bond indebtedness. So as you might notice when you receive your bills, in addition to some of the costs that you'll be responsible for, you will see some of those items there depending on where you live, based on some of those measures that have been passed. As a reminder, the secured property tax rate for the fiscal year that we're in right now, 23 and 24, is 1.17% roughly. Next slide, please. So the law requires that we look at the market value on the day that you become the owner. Typically for residential property, we take the sales price as the fair market value and use that value as the basis of your assessed value. which again, under Proposition 13, is not allowed to increase by more than 2% each year. Again, that is all grounded by the California Consumer Price Index, and you see a value there based on sometimes that index is higher, sometimes it's lower, as some of you might have seen a few years ago when it was less than 2%. Next slide, please. So understanding the difference between the assessed value and the market value concept is what's very helpful for homeowners to understand the impact on your property taxes when there's a change in new ownership or change in ownership or a new improvement done to a particular piece of real property. So why don't we walk through what I mean when I say the assessed value does not increase by more than 2% a year. So you take a look at this slide. You can see that the home was purchased in 1990 for $100,000. Our office assessed the value of the home at that time at $100,000, the fair market value. Per state law, under Proposition 13, the value on which the individual property's tax is calculated cannot increase by more than 2% a year. That's reflected in the line in blue, which shows the assessed value growing 2% annually from 1990, when the property was first purchased, to the year currently in 2024. That current assessed value is $196,000. Again, that is the assessed value. Another name for the $196,000 assessed value is the factored base year value. So the base year value being that $100,000, the factored base year value being how that value grows over time based on that 2% a year increase. You can then compare this value in blue to the value that you see just above it in orange or red, depending on how you see that. This is the home's fair market value, or the full cash value that, as you can see here, has certainly grown more than 2%. As many of you know, it would not be a surprise for a typical home in San Francisco to have a fair market value of $1.2 million in 2024. So just remember that under Proposition 13, the taxes that you're paying are based on that lower and protected assessed value, that blue line that you see there. Next slide, please. So when does that value change? The value, any changes to this value are triggered by the sale of your home, title transfers, or substantial construction work. In this illustration, the sale of the home resulted in a new assessed value that bumped up to the fair market value that we talked about before. So it's important to keep this part in mind as we discuss how Proposition 19 works in the next part of this presentation. Next slide, please. All right, so now let's discuss Proposition 19. And I know there are a lot of feelings about it, but we're going to talk about the specifics of the law as the voters passed it a few years ago by a slim majority. This was a state ballot measure that was passed in on November 3rd of 2020, and it changed the state's constitution, Article 13A, Section 2.1. So before and since its passage, many people have reached out to our office for clarification and to get some help with their transfer questions. It's also been the focus of numerous news articles, which you can see out there. There's been some great coverage on that in many local papers, both in California and in the Bay Area. Proposition 19, it's very complicated law as it changed the rules of two types of reassessment exclusions. The two major components are known as the base year value transfer, and the second, which is another one, the intergenerational transfer exclusion, or the parent to child and grandparent grandchild transfer exclusion. And this is often the more controversial element of Proposition 19. After today's presentation, if you still have questions, please, again, as I mentioned, my staff is here to support you. So we're going to provide our contact information. So you can always reach out to us. We're available email, online, in person, via phone, whatever is best for you. So please don't hesitate to reach out. So with that, why don't we go ahead and begin talking about base year value transfers. Next slide, please. All right. So the base year value law allows eligible homeowners, when they move to another home, to transfer their low protected factor base year value to a replacement home. So you remember that blue line. How do you take that blue line and transfer it to a new property under Proposition 19? Where can you find that number? Owners can find their factored base year value on their notices of assessed value that our office mails out every July. So you can look for that value there in that notice. Transfers can occur anywhere in the state, and each eligible homeowner can transfer the base year value up to 3 times. There's no longer a limit to the market value of a replacement property. Before Proposition 19, the replacement home had to be at or below the original home's market value in order to qualify. This provision in particular provides more flexibility to preserve one's factor base year value for the replacement home. So at this point, let's talk about who's eligible for that base year value transfer item within Proposition 19. Next slide, please. So who is eligible? A homeowner who must meet one of the following criteria that you can see here. The homeowner must be age 55 and older, severely and permanently disabled, or a victim of a wildfire or a natural disaster. Another element is that the replacement home needs to be purchased or newly constructed within 2 years of the sale of the original home. And the homeowner must occupy both the original and replacement dwelling as their principal place of residence. Your home, that's where you live. So the one that you're leaving, or the one that was lost, that was where you lived and was your home, and the one that you're going to, the replacement property, that is going to be your primary place of residence. Next slide, please. To qualify for this base year value transfer, again, that applies to the criteria I just mentioned in the previous slide: 55 years of age of older, disabled, victim of a wildfire or natural disaster. To qualify for this, homeowners must file a claim for the transfer within 3 years after the purchase or completion of construction of the replacement dwelling. So to qualify, you have to file a claim for the transfer within 3 years after the purchase or completion of construction of the replacement dwelling. I know it's a mouthful. If you miss this deadline, and again, it is a deadline, it is a firm deadline, and I'll talk about this throughout the presentation. You want to be aware of all of those items where there are deadlines involved and actions involved to ensure that you gain the benefits that Prop 19 seeks to provide. But if you miss it, and I hope that you don't, you have prospective relief, not backwards, but prospective relief. So there still may be significant costs involved if you miss those deadlines, but you will be able to find relief moving forward if you're in that unfortunate place that you need to correct those items. Next slide, please. So here's a base year value transfer example. As a reminder, there's no limit to the market value of the replacement property, but any amount of the replacement property value that's above the original property's market value, that difference is added to the assessed value to give you a new base year value. So here's an example of that. An eligible homeowner, you're over the age of 55, they purchase a replacement home for $1.5 million. 4 months later, the home that they currently occupy is sold for $1.2 million. The original home has a taxable value, or a factor base year value, of $250,000. Think of that as that blue line we talked about before. And she wishes that she wants to transfer that low value to the new home. Now, in this case, Prop 19 comes into play and maybe some benefit to her. However, since the replacement home value exceeds 100% of her original home's market value, the overage, or the excess market value, well, that delta is going to be added to the original taxable value of $250,000. So in this example, the excess is $300,000. How do we get that? 1.5 million minus that 1.2 million selling price for the original primary residence. That delta of $300,000 is going to be added to the $250,000 for a total new base year value for the replacement home of $550,000. Now, while the base year value is not $250,000 moving forward, it's also not the $1.5 million market value. So just to see how this plays out in terms of flexibility that's offered, but also other factors you may want to consider when considering taking advantage of Proposition 19 and what it does and does not provide to you in terms of financial consideration. So now why don't we go over some of the frequently asked questions that we receive about the base year value transfers. Next slide, please. Okay, so one of the questions we get, let's say I am 54 years old. If I sell my home now and I buy the replacement dwelling after I turn age 55, am I eligible to transfer the base year value, the blue line? The answer is no. You must be age 55 or over when you sell your original primary residence in order to qualify. You can purchase a replacement residence prior to age 55, but you must be age 55 or older on the sale of the original primary residence. So as I mentioned, a lot of moving parts here that you need to consider when planning on how you want to take advantage of Prop 19 and this particular component of it with the base year value transfer. Next slide, please. How long do I have to buy a replacement property after I sell my original home? Well, the answer there is you have 2 years to purchase a replacement property that you will use as a primary residence. So pretty straightforward there. Just 2 years to purchase that replacement property that you're going to use as a primary residence, again, after you sell your original home. Next slide, please. In the case of divorce, a couple divorces. As part of the divorce, their principal residence where they were living was sold. The question that comes up in this situation is, well, would each of the owners be able to transfer their share of the base year value to their new respective, presumptively individual new replacement primary residences? The answer to that is no. That flexibility is not provided under the law for the base year value transfer. Only one person, one claimant, is able to transfer the original property base year value. If both parties qualify, they're going to have a discussion about and mutually decide who is going to receive that benefit for their new home. Next slide. This has to do with co-owners. So am I able to have my child on title with me? And the answer to that is yes. If you and your child purchase the property together from a third party, there is no requirement that the claimant be the sole owner of either the original primary residence or the replacement primary residence. But again, all of the details associated with that kind of transaction is something that requires a very particular discussion per my disclaimer comments earlier before. So again, general information we're providing right now, reminding you that you will need to have more in-depth conversations as you move further along in this process for your particular circumstances. Next slide, please. And as I mentioned, it's important to have a checklist for you as you move through this process so you don't miss any of those deadlines and you're aware of what steps need to be taken to take advantage of the benefit. Most of you will likely see the first type of relief listed on this table. If you're age 55 or older, you file this particular form 19B within 3 years of the date of replacement dwelling, when the replacement dwelling is purchased, or the new construction of a replacement dwelling is completed. So I hope that what I've covered so far gives you a general understanding of Proposition 19's base year value transfer component. And again, that applies to those 55 years of age or older, severely disabled and permanently disabled, and those who've been impacted from a natural disaster like a wildfire and such. So at the end of this presentation, as I mentioned, we'll take some questions from you as well. So now let's move to the next component of Prop 19's other area around reassessment exclusions, for intergenerational transfers. And again, this is the more controversial aspect of Proposition 19. One moment. All right. Next slide, please. Okay. So the intergenerational transfer exclusion. So Proposition 19 changed the rules that apply to transfers between parents and children, grandparents and grandchildren. It limits the types of properties that qualify to family homes only. So the only type of home that benefits is the family home. All other property types, second homes, commercial properties, they do not qualify for the exclusion under this new provision. So the amount of the reassessment exclusion is capped at $1 million plus your home's base year value. So any value that's above that cap, and we'll talk about the nuances there, is added to your original base year value. Next slide, please. So here's a list of who qualifies as a child for Proposition 19. The definition of a child includes a person born of the parent, a stepchild, an in-law child, adopted, and foster children. Next slide, please. The principal place of residence is extraordinarily important when considering the qualifications to benefit from Prop 19. The principal place of residence. To be eligible, the person transferring the property must have lived in that property as their primary home. And again, the one who receives that property must also claim the residence as their principal place of residence, their home, where they go when they're done with work, where they get their utility bills, where they're registered to vote, etc. So in addition to that requirement, it's important to remember that the person who is pursuing this, they must file the homeowner's exemption within 1 year of the home transfer. So this is extremely important because it's a requirement that's stated within the California Constitution, and there is no exception there. So again, these deadlines are extremely important. Next slide, please. The family home, the principal place of residence. Homeowners can show the principal place of residence by filling out the homeowners or disabled veterans exemption form. Those forms are available on our website, sfassessor.org, sfassessor.org. And just, I'll say this again at the end, but again, if you are confused, you want to reach out to our office, you can always, and you don't have this information handy right in front of you, you can always call 311 and ask to be connected. Next slide, please. All right. In terms of family home multi-unit dwellings, it's important to remember, we've gotten a lot of these questions, that for a multi-unit building, such as let's say a 4-unit building, and all 4 of those units are apartments, let's say, only one of those units, the principal unit, is going to qualify for the reassessment exclusion because that is the primary place of residence that would be transferred. Everything else is going to be reassessed in terms of that property because it's not associated with the primary place of residence. Now, there's an exception for ADUs, accessory dwelling units, where the ADU is combined with the primary residence together. They qualify for the reassessment exclusion. Next slide, please. So 2 filing requirements must be met. Just make sure you pay attention to this slide. Maybe save this one, take a photo of it when you get a copy of this. Note the different timing deadlines that are here. And again, remember that I'm mentioning lots of moving parts, lots of moving pieces. It is something to pay attention to. The exemption form for the principal place of residency, that has a 1-year deadline. The exclusion from reassessment claim, that has a 3-year deadline from the time of the transfer. This deadline only applies if the property has not been sold. Again, if the deadlines are missed, there's prospective relief from the date of filing, only if the property is still owned by the transferee. So again, relief is not going to be retroactive. It's only going to be prospective moving forward, and that's going to come with a cost. So again, pay attention, please, as you're going through this, your family members, to those deadlines. Any question about them, reach out to us. We're happy to provide that information to make sure that you're on track and you're on time. And remember, if you have any questions of like, well, I wonder if the clock started ticking on this date or that date, reach out. It's always better just to engage and know the rules so that you don't miss out on this opportunity at a cost to you. Next slide, please. All right, so here's an example. A parent transfers her principal residence to her child on March 1st of 2021. The child moves into the property and files for the homeowner's exemption and the reassessment exclusion on February 1st of 2022. Both of those claims are filed timely, and the child is eligible for the exclusion as of the date of the transfer on 3/1/2021. So again, they met within that 1-year timeline within it, and they're eligible for the exclusion, fill out the appropriate paperwork. They're set in this example. Now let's move to the next slide where we talk about a late filing and prospective relief circumstance. So here's an example of someone who missed a deadline filing. The parent passes away, and this is important to pay attention to. The parent passes away on this very particular date, on June 15th of 2021 in this example. And there's an estate plan, fortunately, that leaves real property to the child, to a child. The child moves into the home amidst all the issues of life and going through the grieving process and taking care of the brass tacks of what that's like. But they file the homeowner's exemption on August 2nd of 2022. So again, what's a timeline to file the homeowner's exemption in a timely manner? In 1 year. So in this case, the child filed the exemption over 1 year after the date of transfer, and the assessment, the exclusion from reassessment, was filed on January 22nd, 6 months after the transfer. The exclusion claim was filed timely, but not the homeowner's exemption claim form. It wasn't filed within 1 year, so the child is then, in this case, eligible for prospective relief, and the exclusion would apply as of the 2022 lien date for the 2022-2023 fiscal year. The child would have to pay then a supplemental assessment because the value would increase during that time period for that 2021 through 2022 case. The treasurer and tax collector will make the base year value adjustment, and the controller's office will issue a refund with interest for the year the exemptions claim was filed. But just remember, there are some costs here associated with missing those deadlines, and given the value of property, they can be significant for that period of time. Next slide, please. The reassessment exclusion, or the new value cap. Proposition 19 requires that our office applies a valuation test to the reassessment exclusion claim. The value cap for the exclusion is the sum of the factored base year value plus $1 million. Now, I'm going to give you an example to make that much less complicated, but this is the language. Any excess market value that's beyond that cap, that $1 million that I talked about earlier, that's added to the base year value as a property's new base year value. So as I mentioned, why don't we go ahead and go over a couple of examples. A death occurs on the next slide. A death occurs on June 2nd of 2021. The family home is transferred to the child. The factored base year value of the home is $800,000, and the market value of the home is $1.6 million. So the property qualifies as a family home, so that part has been taken care of. And the eligible transferees, they filed both the claims on April 15th of 2022, so they did the filing. To calculate the value cap, we add $1 million to that factored base year value. As we mentioned in this case, that factored base year value is $800,000. You add the $1 million to that, $1.8 million. So there's no additional market value that needs to be added to that because the market value doesn't exceed the value cap. The value cap is, in simple terms, your existing factored base year value plus that $1 million. Anything above that, you would have to add that amount to the factored base year value. In this case, since the 1.6 million is less than the value cap of that 1.8 million, there's no addition, there's no adjustment required to the factored base year value. So they're able to transfer that existing $800,000 right on over and continue to benefit from Proposition 13's cap and the factored base year value at that amount to increase over time per year at no more than 2%. So that's a benefit in this particular circumstance. Next slide. So in this example, we'll talk about a new taxable value where there is additional value added to the existing lower protected factored base year value. In this example, the death occurs on April 3rd of 2021. The factored base year value of the home is, in this case, $400,000. The market value of the home, however, is $1.6 million. So the home qualifies as a family home, so we know that it qualifies. The eligible transferee files both claims, in this case, on January 15th of 2022, so within the timeline. So they've taken care of that, but there's this other factor. They need to calculate what the value cap is to find out if there's going to be additional value added to what already exists on the books. In this case, the answer is going to be yes. Our office adds the factored base year value, in this case, $400,000. You add $1 million to that, you get the value cap of $1.4 million. In this example, the market value is $1.6 million. So it's greater than that value cap allows. So then there must be new value, in this case, per the law, added to this. So you combine the excess market value, 1.6 million, you subtract 1.4 million, you get, in this very rough, easy numbers to work with, $200,000 delta that must be added to the factored base year value. $200,000 plus $400,000, $600,000 becomes the new taxable value moving forward as of the transfer date. So this is an instance where there is still a bit of a benefit, in this case per the law, but there also is additional value that must be added based on how the rules have been structured and approved by the voters. In this case, an addition of $200,000 of assessed value to the property. Now let's go over a few of the frequently asked questions. And I notice some questions are coming up right now, and so if Sheree or others can provide responses in there, that would be great. And then perhaps if we have time, we can read and answer some of those questions out loud. But in this case, here's one frequently asked question. My mother leaves, and this is about trusts and trust distributions. My mother's trust leaves her home to me and my two siblings equally. Will this property be subject to reassessment as of our mother's passing? So a very general question, but we have to look at the particulars here based on the details of who's going to occupy the home, or is someone going to occupy the home? Is it going to be their primary residence, etc.? So let's look at the answer. At least one of the children or the qualified heirs must occupy the family home as their primary residence, their primary principal place of residence, within 1 year of the transfer. Both the homeowner's exemption and Prop 19 exclusion claim have to be filed on time in order to qualify for the exclusion from reassessment as of the date of death. So just in this very particular question, making sure that one of the siblings has to occupy the home, they have to qualify. All the issues around filing timely, because if you don't, yes, there will be some costs associated with that where prospective relief can be applied, and making sure that people are paying attention to those details. Next slide, please. Another question that we've received in past presentations is around LLCs and how people structure the family home within them. I've heard that parents can set up an LLC with their children and put the house into that LLC. Since ownership doesn't change on the death of the parents, the property isn't reassessed. Is that correct? Well, the answer is a little bit nuanced. It's important to note that it's not always just a blanket yes or no answer here. It's important to note that LLCs are not always an automatic avoidance of a reassessment. So again, broad strokes are not the way to go when considering Proposition 19 and its impact on you and your financial decisions. You want to pay attention to the particulars of your specific case. Again, that's why we talk about guidance provided here, general information provided here. There might be particular language that needs to be reviewed in order for us to determine this. So that's why we're sharing here that LLCs are not always an automatic avoidance of a reassessment. California property tax laws governing legal entity ownership transfers are very complex, as I mentioned, and they should be discussed, as I mentioned, with a qualified estate planning attorney and financial advisor. So as an example where a reassessment would occur despite a property being in an LLC is a situation where there might be a change in control in which one member of the family gains greater than 50% interest. And in that case, that would trigger a 100% reassessment of the property. Specific to your question, if a parent passes and a result, one member of the family gains greater than 50% interest in the legal entity, well, then the entire property would undergo reassessment. So again, complex, requires conversation and analysis. And so the purpose of highlighting this question is so that to remind you to pay attention to the particulars and ask those questions. No one is expecting anyone to understand this right up front. In fact, it takes multiple times to really make sure that you are solid on what your next steps are going to be, and if, when, and how you need to plan for financial impacts based on the particulars of your situation. Next slide, please. So let's say, what if the child moves out in the circumstances? If another eligible transferee, like a sibling, moves into the property within 1 year of the other moving out, and timely files for that homeowner's exemption claim form, it's fine. The exclusion continues. The rule is that the heir must claim it as a primary place of residence. They're an eligible transferee. They move into the property, as we said here, within 1 year of the other moving out. They file the claim, and therefore the exclusion continues. So if no other eligible transferee moves into the property within 1 year, then the exclusion is removed. So again, making sure that timelines are being paid very close attention to. Next slide, please. So again, a checklist here for your consideration. The table neatly organizes all of those Board of Equalization forms, filing deadlines for intergenerational transfer exclusion purposes. I know it's a lot of words. It applies to your situation, whether the property is transferring from one generation to the other, or in the other circumstance of whether you are, as a senior, someone who is disabled, with the associated criteria, or have been impacted by a natural disaster and are seeking to move one residence to the next. Those are the circumstances. Just know that there's different language for both of those under Proposition 19, and make sure you understand the rules under each. Next slide, please. Here we are in terms of, well, is the $1 million amount static? No, it is not. It moves and increases in phases based on the housing price index for California. So the Federal Housing Finance Agency announced that the annual percentage change in the housing price index for 2022 was 2.26%, and that was effective as of February 16th of last year. We've just been saying $1 million just to keep things rough and easy for us in general, but that $1 million was bumped up to a new amount of that you see here, this $1,022,600. So as such, the transfers that occur February 16th through February 15th of 2025 next year, The value cap is the sum of the property's factor base year value plus this new amount of $1,022,600. So the next adjustment for that 1 million amount will occur, as I mentioned here, in February of 2025. Next slide, please. All right, so Proposition 19 repeal, because as I mentioned, this has been a component of Proposition 19, the generation to generation transfers, intergenerational transfers component that people, quite frankly, felt hoodwinked by, given that the context in which Proposition 19 was placed on the ballot, people were paying attention to the natural disaster component and its impact on seniors and those who were disabled. They were not well versed and aware around this component of intergenerational transfers when they were voting on this measure that again won by a slim margin back a few years ago. So some educational information that I'm able to share as you track this issue is that there have been efforts, unfortunately they have not been successful to date, to repeal Proposition 19 because it requires a state constitutional amendment, meaning it has to go back to the voters. There are two ways, it's probably the most likely case in which that would be changed unless the legislature changes its mind. There are two ways to amend the Constitution. The first is an amendment proposed by the state legislature. With a 2/3 vote of the Senate and the Assembly, the measure could be placed on the ballot. There was a Senate constitutional amendment introduced by a senator from Southern California last April, in April of 2023, that would require 2/3 vote from the Senate and Assembly to be placed on a ballot. This measure would reinstate the prior rule to allow the transfer of the principal place of residence and $1 million of other real property. So a bit of a compromise there and a change. The second method is a citizens initiative, and that requires a number of valid signatures of registered voters equal to 8% of the number of votes cast for the governor in the last election. For the November 2024 ballot, that was a number over $800,000. To be certain, enough valid signatures are submitted to the Secretary of State. Proponents gather and submit, in cases like these, at least 1 million signatures. There was an initiative led by the Howard Jarvis Taxpayers Association to see if they could qualify for the November 2024 ballot. Was very recently underway. The state deadline to submit those signatures was earlier this month, and what we know to date is that it was not successful. So in 2022, there were also efforts to collect signatures for an initiative that would repeal this portion of Proposition 19. And again, there were not enough signatures to collect in time to get the initiative on the November 2022 ballot, and we have not seen movement at the legislature that would make these changes. Again, this is going to require advocacy, the money to support that advocacy, and I would guide you to take a look and search for the Howard Jarvis Taxpayers Association to learn more about their efforts in the future after this latest and most recent unsuccessful attempt to gather enough signatures to change this measure. In addition, you can always reach out to your elected officials, encourage your friends and family members to do so, to live up and down the state of California to do the same. If this is an issue that is important to you, because that is where the opportunity exists as well. Next slide, please. All right, so that is the end of our presentation. As I mentioned, we have staff ready to help answer any questions in particular in a more nuanced fashion in relationship to your particular questions. You can always reach out to our office, as I mentioned, for any questions, any concerns, any guidance about this or anything else associated with property and understanding how to interact with our office, the notices that you receive. I see a question here around, will we get a copy of these slides? The answer is yes. For everyone who signed up, we are going to email you this presentation so you have that. You can see here some additional information where you can find out more about Prop 19, those frequently asked questions from the Board of Equalization, and guidance around Prop 19. And as always, you can review items on our website as well as sfassessor.org. Next slide, please. With regards to low-cost legal resources, our city is very lucky to be home to a few community-based organizations that are focused on providing affordable legal services. There are 3 organizations that we have worked with in the past, and they have a proven track record of offering vital legal services to homeowners for estate planning, especially for under-resourced community members. They include the ones that you see here: housing and economic rights advocates who we've been partnering with to provide low-cost or free estate plans since I took office. Of course, legal assistance to the elderly who have also been part of our family wealth forums that we have in person once a year. The next one coming up later on this summer. One of the first during my term last year at the Ocean Avenue City College campus. Open Door Legal for additional legal assistance, and of course for questions specifically for the state, the Board of Equalization, the Taxpayers' Rights Advocate Office. And again, if you have issues with contacting any of these organizations, please do reach out to us. We're always happy to make those connections and follow up on your behalf. There's no wrong door. We want to make sure that you get the service that you're looking for. Next slide, please. So the timeline just in general for our office, again, just taking a step back from Proposition 19, and this is more about the general elements of our office. The lien date on which the assessed value is considered is January 1st of each year, so New Year's Day, and that's the lien date. I just want to thank people that are asking and answering questions in the chat section right now as well. February 15th, that's the exemptions deadline. Make sure if you have any questions about exemptions, if you're focused there, you're a new homeowner, et cetera, make sure you get those filings in, and reminding your friends to do the same if they're new homeowners. Are you taking care of your business in relationship to that? We don't want anyone to miss out on any opportunity. And then June 30th is roll close for us when we submit all of the assessed value in the city and county of San Francisco, a particularly challenging environment for us, given the extraordinary increases in workload based on the number of appeals that we're managing and otherwise. Real property, the notice of assessed value, a notice, it's not a bill, if you notice it says on there, comes to you in July from our office. You get your tax bill from the treasurer and tax collector in October, reminding you of the 2 bill deadlines that you have for December and April. Any questions about your tax bill, payment plans that might be necessary, questions there, reach out to the treasurer and tax collector in relationship to the bill. When you receive your notice from us in July, that's the opportunity to talk to us and say, I don't think this is my assessed value. May we have a conversation? Reach out to us so we can work through those items. For business personal property and possessory interest questions and timelines, July is when we send out that notice and the tax bill as well for business personal property. And then in August is when that tax bill is due. August is when that tax bill is due for business personal property. Next slide, please. And again, we're right there on the first floor of City Hall, room 190, first door on your right as you move through security. We're open 8 a.m. to 5 p.m. Come on in and say hello. You can always visit us on our website and see what information you have and questions that can be answered through our frequently asked questions. You can call us at the number here. And if you forget our number, you can always call 311 and ask, let them know you have property tax questions or property valuation questions, or you just want to talk to the assessor's office or recorder's office. They will connect you. And then, of course, you can always email us. We can answer your questions at assessor@sfgov.org.